What's going on, everyone? This is Real Talk Real Estate, and I am your host, David Green. In today's show, we're going to be covering questions about should I sell it or should I pay it off? How to allocate capital. A lot of people are wondering about this in today's market because a strategy of buy, acquire, get, scale, get as big as I can possibly get is not always the wisest when the economy is in the condition it's in and interest rates are at the level that they are. So we're going to be talking about how to best situate your portfolio to survive so that you're in a position to thrive when the market does turn around. And if you haven't heard the show, we take questions from people like you about what to do with their money or how to solve their real estate problems, and I do my best to answer them. So if you're looking to build wealth, change your career, or just learn about the craziness that goes on behind the scenes in the real estate biz, you've come to the right place. All right, let's get to our first question.
All right, David, one shaved head to another, one YouTuber to another. Thank you for taking my question. So I have three properties. One I own outright with a tenant and has an old home equity line of credit on it that I haven't used. I can't really get more for that because I'm not living there. That's in South Carolina. My second property is in South Carolina. I need to either rent it or sell it. And if I rent it with taxes going up because it's no longer my primary, it will not cash flow or be maybe a little bit of a negative, but it's built in 2017. It's a townhouse. It's in great shape. If I sold it, I could get 20 or 30K, maybe put that into like a property management business I'm thinking about doing. And then the final property I'm in that I cannot house hack, David, I have a mortgage on and I'm living here with my family. So what should I do with that second property? Rent or sell? I could get like 20 or 30,000 if I sell.
All right, John, great question. I love this. So let me make sure I understand what you're saying correctly. What I'm getting here is you have a property that you used to live in as your primary residence. You moved out of it, made it a rental. We call that the sneaky rental tactic because you can buy it for very low money down, as low as 3%. Then you can move out of it and make it a rental, which is a lot cheaper than if you had to put 20% down. There is also a primary residence capital gains tax exclusion, where if you live in a primary residence for 2 years out of a 5-year period, you're eligible to sell it and not pay capital gains on the profit. So your CPA is telling you, hey, you're going to have to sell it soon because that 2 years that you lived in it out of a 5-year period is about to expire. It's been too long since you've lived in it. So you're going to have to sell it, which I think could be wise if you're not making a ton of money or if you don't think it's going to appreciate. Now you're asking me, we've got this equity that's coming out of it. Where do we put it? Should we buy another house or should we put it into a house we already have? You mentioned that you've got a property in Scottsdale, Arizona. So you and I have a little friendly competition going on because Rob Abasolo and I own a short-term rental out there in Northeast Scottsdale. And you're trying to figure out if you should pay down the mortgage of a property you already have to increase the cash flow with the money that came from selling the investment property. This is a really good question. This is exactly why I love doing my job. It's fun to try to figure out the most efficient way to use the money. Now, one of your concerns was if I buy another property with today's rates and with the way that these properties are performing, I don't think that it's going to cash flow. And I think you're wise for recognizing that. It's not a guarantee. It's not like in any market, all the houses work or all the houses don't. But it isn't uncommon to see that it's much harder to make it work in today's market. In fact, every day I get DMs or comments on my Instagram or people emailing me saying my short-term rental is losing money. Should I sell it and take a loss because it's gone down in value, or should I hold it and continue taking a loss every month? What's the better loss? And this doesn't come up very often. You don't hear this on all the inspirational real estate shows, but this is Real Talk Real Estate, so we're going to give it to you real. This is the actual dilemma that a lot of people are facing. If you were going to buy another property, I would want you to be able to tell me how you need the depreciation from that purchase to offset income you're making somewhere else. Because if you're not, it probably doesn't make sense to go buy another short-term rental that's going to not perform well when you already have some that are not performing well, which leaves you the option of taking that money and putting it towards paying down the mortgage balance, maybe recasting the loan. If you guys aren't familiar with recasting, you can actually take money, say $200,000, put it towards the loan balance you have, lower the loan balance, and then redo the loan at 30 years all over again so that you bring your mortgage down, which would increase the cash flow on an existing property. And and you could keep the interest rate that you have. You're not going to have to lose your interest rate by refinancing. So that is an option for you. Something else that I like about that, if you do it, and then in the future, you find other properties that you want to buy, the market gets better and you want to grow your portfolio again, you've still got the equity sitting in the property. You haven't lost the ability to purchase. You've just delayed it. And during the period of time that you're waiting, you're going to cash flow more on a property that hasn't been doing as well in Scottsdale. So if we're going to take the conservative approach, which is the vibe I'm getting from your question, John, I like selling it, avoiding the capital gains, taking the profit, paying down the mortgage of a property you already have, making that one perform better, weathering the storm of this rough economy that we're in right now that's been very hard on short-term rental operators, and waiting with the equity there so that when the economy turns around, when markets heat up, when people are traveling again, when short-term rentals are making more money, you go buy another good asset and you start over. When you understand strategies like this, you can survive for the long term. You got to figure out how you move your equity and what tools you have available to do it, because all real estate will always make money if you hold it for long enough, which means that your goal as a real estate investor is to figure out how to weather these storms so that you can hold it for a long time. John, thank you very much. Send me a follow-up question if you have anything that I didn't cover there. And if you're watching this on YouTube, make sure you leave me a comment to let me know what you thought. All right, everybody, if you would like to ask your question and be featured on this show, simply head over to davidgreen24.com/ask. Remember that there's an E at the end of my last name. You can submit your question and have me answer it here on the show.